So inflation versus labor, those are going to be the two big things to watch in the economy this year. So that's the title, and then we'll go into details about this. So first, I got to get the disclaimer going. This is just my opinions, does not necessarily reflect the thoughts or opinions of my employer. And Benchmark Mortgage would also probably like to distance themselves from my corny jokes and other attempts at humor. So now that we got that out of the way, the roadmap for today, the word of the decade is debasement, and we'll get into that. The two-faced U.S. economy, we'll talk about the strong parts, GDP growth, but the weak part is consumer sentiment and job situation. Then we'll get into the housing market, which will be of the most interest probably, and then I'll get into my fearless faircast, okay? So, word of the day, or word of the decade is debasement, and in talking with my daughter who just got out of college, I was explaining to her that the definition of debasement is the place where the college grads come back to live when they can't find the job. So, so what is debasement? Well, debasement really is the loss of value of the dollar, okay? And in some ways, you might even say intentional loss of value of the dollar. And so some of you are looking at me like, what are you talking about? And in fact, when I show this next chart, you'll see, yeah, wait a minute. The dollar's fine. Look, here's the exchange rate. You can see, how many euros does a dollar buy? Well, that seems to be increasing somewhat in that chart. How many yen does it buy? Well, that seems to be increasing in that chart. How many pounds does it buy? So really, if you look at this chart, you might say, well, the dollar's actually appreciating from what I can tell, because I can see it in the exchange rates. So that's the problem with fiat currency, meaning the dollar or any of these currencies that are just kind of a piece of paper, right, at the end of the day, or a 1 and a 0 in a bank account. And so all these countries make up their currency and they fluctuate against one another, but each of these countries is printing currency like it's going out of style and running up debt like it's going out of style. So it's not really the right thing to look at when you're talking about what is the value of the dollar. So I'm taking one, the next slide, well, in fact, I'll go. Compared to gold, how much gold does $1, or how much does it cost for an ounce of gold? And an ounce of gold is about this size, okay? And by the way, this is not actual gold. Do not hit me on my way to the parking lot because it is getting more and more value. This is a Chuck E. Cheese token from 1986, so just know that. But an ounce of gold is basically $4,500 now. And you can just see what it has done over recent years, certainly since the COVID mess that we went through, but really even if you go back decades, okay? So why is an ounce of gold doing that? What is it that gold is doing that is making it so much more valuable? Like, is it shinier than it was before? Like all of a sudden it got shinier than it did before? No, not really. Are people kind of going back to the Mr. T look with a bunch of gold jewelry and that's really a popular look? No, that's not it either. Like the answer is that gold is the same. Like this size, an ounce of gold is basically this coin, if it were gold, would be the exact same coin that it was 5 years ago. But somehow the value has gone way up. Why is it? Well, I'm here to argue the value has not gone up. The value is exactly the same as it was 5 years ago. Well, then what has changed? The value of the dollar has changed. So it's not that gold has gone up, it's that the dollar has gone down, okay? So that's sort of an aha moment of debasement is we are debasing our currency, meaning the purchasing power of your currency is going down. That's the thing. We have this word that people use called inflation. And you say, we all kind of know what inflation is, right? It's the change in price, but like nobody really understands why. Why do we have inflation? Like what is inflation? Well, inflation is not that, yes, it's one thing if your crops get more expensive because there was a drought, right? And so crops are all of a sudden more valuable because there are fewer of them. We get when prices change for that reason. But if prices are just going up for no real reason, it's because the value of the dollar is what's changing. Okay? So the key here is that wages need to rise faster than inflation, or else consumers are going to start panicking because their purchasing power is falling, right? If you're making a little bit, if your wages go up 5% a year and inflation is only 3% a year, then you're actually going to feel like you're getting ahead, right? But if your wages are going up 1 or 2% and inflation is 3%, you're going to be falling behind. So the difference between wage growth and price changes are really what's important to consumers. And I think the key here is you need to rethink the amount of money that you hold in cash, for the long term. Hard assets, like a dollar or a silver or whatever, tend to hold their value better than what we're seeing on the U.S. dollar. And as it relates to homes, I'll get this is sort of stealing my own thunder, but in the long run, if you were a renter in the long, right now I think it's actually cheaper to rent than it is to buy. Okay, and I know that's a hard truth, but I think mathematically, most of the studies show that right now it's cheaper to rent than buy. But that rent is going to go up every year as the dollar gets debased, right? Forever. Whereas, if you are purchasing and locking in a price, at some point, those price increases are going to make it where it was much better to buy in 2026 than it was to rent, even though the current comparison is that renting is cheaper. When those rents keep going up, then we will look back and say, wow, I wish I'd bought back in 2026. Okay, so gold didn't change, all right? But is this something just about gold, something about currency and central banks? I mean, there's some of that central banks are worried about the dollar, so they're buying gold. But here's silver. What about silver? Okay, well, you might argue, all right, well, weapons need silver and various electric batteries and solar panels need some silver. So yeah, silver's in more demand. Okay, how about real estate? This is the Case-Shiller index, and you can see, I mean, why is real estate? It's not like, I mean, our population in the U.S. is actually not really growing. In fact, I would say it's probably shrinking this year for the first time in a long time with all the immigration reversal thing going on. So the whole point is we need to rethink how we think about the dollar as it relates to these hard assets. And so the dollar is being debased. And so whenever you're making decisions about economics and whatnot, understand that there is this big trend that makes owning hard assets like gold, like silver, like real estate more attractive than they otherwise would be if we were not debasing the currency. And so we're going to talk about a lot of economic stuff, but just understand this is a long-term trend that is going to be continuing. There's I'm not a big reader, and so I haven't read this book. I don't want to pretend like I have, but it's a famous author, Ernest Hemingway, and he wrote a book called The Sun Also Rises. And in The Sun Also Rises, there's a character that goes bankrupt, and somebody asked that character, how did you go bankrupt? And the answer, of course, is he says, well, I went bankrupt 2 ways, gradually and then suddenly, right? And so it's not like we weren't running deficits for years and years and years in the U.S. It just didn't really matter, right? So we were able to kind of get away with the fact that our national debt was growing. But now we're noticing it because the number is so big and that we're having to pay interest, and that crowds out our investments in welfare or in positive things for everybody, in defense or whatever. And so anyway, we're only noticing it now. So we've kind of gotten past the gradually part, and we're kind of in that, oh, suddenly this is important, and suddenly this is something that's going to matter to us economically that hasn't mattered in the last, well, really ever. Okay? All right, so let's talk about the two-faced economy, because you can probably get arguments from just about anybody how it, somebody probably asks you, I mean, you have buyers especially, hey, how's the economy? How's the housing market, right? You get asked that all the time. I know I do. I know my team does. So the two-faced U.S. economy. Well, on one hand, if you want to look at GDP growth, and GDP is often used as the scorecard for an economy, like, are you a growing economy? Or, I mean, businesses. Or realtors, are you growing? Is your business growing? Is the economy growing? Well, GDP, the amount of activity, sales of goods and services in an economy, I mean, that looks pretty positive. That's a very positive trend. Now, keep in mind, it's in nominal terms, which means that's because inflation. Inflation is driving that, right? So the dollars go up because the dollars are worth less. So even if you transact the exact same amount, it's going to look like it's going up. So if you look at quarterly GDP, you can kind of ignore the left side of this chart, where in 2021, we were recovering from the lockdowns, and then it kind of got quiet for a little bit. But you can see that really the last couple quarters have been pretty strong. And what you're seeing in this chart, I think, is real strength. But keep in mind, a lot of it is this AI build out, right? And that is real. I mean, I actually have a couple of loan prospects that I'm talking to in early stages with, but who are actually building these data centers, right? I mean, construction, like literally driving out to Abilene and building these data centers. So there is money being spent to build stuff, right? And so that is causing GDP to grow at a very impressive 4.3%. So that's a really positive number, right? So if you're looking for the goods and the bads in the economy, well, this is a really positive thing. The question becomes, is it sustainable, right? The first question is the AI boom real? Like, is it going to last? And there are some people who don't think so. But then the other thought is, okay, well, do we get to a point where it's all built out and then these construction workers or engineers or whatever it is, like, what do they go do then, right? So we don't know. But as of right now, this boom is really powering GDP in the U.S. economy. And that's a positive. And then, like I said, that kind of trickles through to us, where, like I said, I've got these two different guys that I'm talking to who I think eventually in the next few months will be buying a home, each one. And it's because they have this really good employment building data centers. Okay, so that's positive. But the problem is that a lot of this, again, goes back to the stimulus that our government is putting into the economy. And the government has always, whether you're talking about the Fed or whether you're talking about the U.S., the Congress and the president, but they've always stimulated the economy with spending and whatnot. But really, after the 2008 great financial crisis, did we really change the way the U.S. economy is stimulated, okay? And basically, we've been, I'll call it printing money. It's not literally a printing press, but we've been expanding the money supply, doing things called quantitative easing, which is basically the Fed buying assets from the Treasury, which that is hard to get your mind around because most of us think of the Fed as government and the Treasury as government. Anyway, understand that we're just expanding the money supply, right? And we're also spending, we're running a deficit of $2 trillion a year. If we bring in approximately $5 trillion or so a year in government revenues, meaning like taxes, but we're spending $7 trillion a year, we're having to put that extra $2 trillion onto the national debt every year. So that just keeps growing, right? But when you keep doing that, that helps stimulate the economy, right? And that helps people want to go buy houses and cars and do all these things. The question is it sustainable? And that's a concern, because at some point it doesn't seem like it would be sustainable. So, okay, let's look at the other side. People say, well, the economy's not doing so well. Okay, well, why do you say that? Well, jobs. Job creation is not as strong as it was. We can make our jokes about whether we trust the data that the BLS is producing, but even whether you trust it or not, you can see the shape of the curve as far as we're really not, Chairman Powell at the most recent Fed meeting, he always gives his commentary after they make a rate decision, and he basically said, look, we think the numbers are showing slightly positive. We ratchet that down by 60,000 jobs a month, so if the most recent number was a 40,000 job creation, we actually think that it's negative 20. So basically, we're in that range that's near zero job growth. Now, there are some people who say zero is okay, and especially if we have this out-migration going on, whether deportations or self-deportations. So our population is kind of shrinking a little bit, so I guess maybe zero is the new 40, I don't know. But job growth has slowed down. So it's going to be really hard for the economy to continue growing if we don't have employers willing to keep creating jobs. The unemployment rate is super low. I mean, if you look at historical numbers, our 4.6 I mean, I know 20 years ago, anything south of 5%, and people said, that's impossible, you're not going to get below 5%. Well, we've been proving that we've been below 5% now for a while, except for the one little COVID bump. But what you do see in this chart, these gray bars represent recessions that actually happen, declared recessions in the U.S. And what you can see is that each time the unemployment rate starts to go up, every time there is a recession right after that, and it goes up dramatically. Now, that doesn't mean that that's definitely going to happen here, but what I'm saying is you can look at the chart and see, the unemployment rate does seem to be going up a little bit, and every other time that has led to a recession and the unemployment rate going up even faster. Doesn't necessarily mean it will be this time, but that has been the case every other time. Job growth, this is one of those things, and as a proud North Texan, I've always enjoyed saying, yes, but, look at Dallas-Fort Worth, and I could show you a positive chart. Well, I'll tell you what the positive chart says. Of all the metro areas in the country, since pre-COVID, we've created the most jobs. That sounds really positive, right? That is positive. But if you just want to look at the last year, we've really slowed down on our job creation. We're kind of middle of the pack. So that doesn't mean that, maybe we're just taking a lull and digesting and all that, but like this idea that we are creating so many more jobs than every other metro area does not match with the BLS statistics right now. We're right there in the middle of the pack at 0.8% growth year over year. So that's not that exciting news. So the job front is a little bit weaker than I think we would like, okay? And because of that, because of the weak job situation, and it doesn't mean there's huge layoffs right now. There have been some announced layoffs, but layoffs haven't really, you saw the unemployment rate hasn't spiked. So it's not that layoffs have become a problem, or at least not yet, but it is really hard for college grads to find jobs right now. I had 2 kids graduate college in the spring, and I saw it with them and their friends, and it wasn't as easy as it was in some of the previous years. So between uneasiness about the job situation, and then on top of that, the cumulative price increases that we've seen, right? Inflation since COVID, it got up to 9% and has come down to 3%, but those things add up. They're cumulative. It's not like prices went down. Prices just went up by less to get down to 3%. So 3% means it's 3% more than last year. So these cumulative price increases, all those kinds of things have made consumer sentiment pretty low. And I don't know if everybody's heard the concept of the K-shaped economy. Anybody heard that term? So there's a term, everybody tries to use these visuals to say what's the economy looking like, with the recovery or the decline. And there's been this kind of term coined called the K-shaped recovery. And so basically after COVID, how did the economy recover? Well, assets went up, and so the people at the higher end of the wealth spectrum, that their assets went up in value, whether you're talking about stocks or real estate or Bitcoin or whatever. The people who had these assets, they're feeling pretty good about the economy. But generally, that's it's always the 80-20 rule, right? So maybe that's 20% of the economy is feeling pretty good, but the bottom 80% who don't really own that much in assets haven't seen that boom, and meanwhile, they're getting hit with inflation and they're worried about their job. So you have this K-shaped economy because it looks like the 2 legs of a K, where you have some of it going up and some of it going down, but very few staying sort of neutral or in the middle. So that's, when you look at consumer sentiment, you're talking basically the 80% are not feeling very good about it, and it's only that top 20% that are feeling pretty good about the economy right now. And I told you continued inflation, the cumulative impact. So why is there so much uneasiness? And I know when I start breaking out the math terms, that is the death knell as far as attention spans. But there's a difference between means and medians, right? Oh, I just lost a few people just with that one sentence. But the mean and the median, and sometimes you'll say, well, the economy, I showed you, the economy seems to be doing pretty well. We've got this growth rate going at 4% or whatever it was on GDP. Well, that's kind of an aggregate that's the mean, but keep in mind, not everybody owns a data center, and not everybody is a big AI company. Like those companies, things are going really well at those companies right now. The profits are good. The stock options are great. Like there is a lot. Even I told you, even some of these workers are really making good wages because they've got steady work and overtime and all these kinds of things. So there is a group of people who are feeling pretty good. But the median is the one where you look at the person in the middle of the income spectrum or of the wealth spectrum, and you say, well, the person in the middle really isn't feeling that. They're not seeing the benefit of that. And so while the mean seems to be going up because it's being brought up by the high end, the median is not going as well as the mean because the middle person isn't seeing the same benefits as that top 20%. Okay? I'll skip on to the next. Okay, we'll talk about housing. Okay, there's a lot of really busy stuff, busy charts, and so I'm not going to spend a ton of time on each chart because, and again, I didn't say this earlier, we will make sure you get a copy of these slides, so there's data and pictures and all that stuff, so we can talk about it, and you're welcome to take photos if it's a specific chart. I'll pose, I'll give a big smile, and you can, just make sure you show the camera. No, housing trends. Okay, so just as you've lived this, but we melted down in the great financial crisis. When COVID hit in 2020, we reactivated all this stimulus, and boy, we saw what happened to home prices. Really knocked it out of the park. But then when mortgage rates rose in mid-2022, that's when the brakes hit, okay? Everybody in this room knows that. We felt that. We lived that. Okay, so we have been in a housing recession, for lack of a better word, since then. And a recession just means a slowdown, right? It slowed down pretty dramatically. So buyers are just hesitant, right? We've got affordability questions, especially once you get, yes, rates have gone up to what are traditionally called normal levels, but a lot of people think of them as high compared to where we were at those 3% days. But in addition, property taxes and insurance and HOA fees, a lot of times, people are struggling with those things. Okay, so you know that. So you know this, that in 2024 and 2023, those were the two slowest years since 1995 as far as the number of transactions. We kind of bottomed out at around 4 million transactions in the country as far as home resales, okay? So how did 2025 do? Well, according to NAR, and I got this from the Wall Street Journal, but the pace for last year was 4.13 million. So it was up a little bit. Not enough to get everybody excited. I'm going to go back a chart and see that we were up at 6 million in 2021 as far as, so it feels slow compared to back then, and it obviously has been slow, but 6 million was not a normal number, but certainly 4.13 doesn't feel like a real great bounce back that we saw in 2025, and it wasn't. It was a small bounce back. Price change. This shows you that cumulative price change that I talked about earlier, and you can see just the huge spikes in 2021 that prices just went up, and so that we've come back down to very small price appreciation, 1%. These are national numbers. But again, keep in mind it's a cumulative thing, right? So prices haven't necessarily fallen on a national basis. But the price increases have continued to slow down. The good news is that, hang on, I'm going to go back a slide real quick. 1.2% was the most recent year-over-year price growth in the nation, okay? Well, the good news is that wages are actually increasing faster than that. So I told you earlier, that's the key to people feeling better about things, is if their wages are growing faster than expenses, right? So if they're growing faster than home prices are growing, if they're growing faster than the inflation rate, that's a good thing. So the good news is right now it appears that the price increases have fallen below the increases in wages. Okay, so this is where I start talking about the really busy chart. This is all of DFW, and this is November's sales, unit sales, by zip code, and you can see there's some real green and some real red, right? So those are plus 10% for the dark green, or minus 10% or more for the dark red. And you can see it's all over the place. This is by zip code, and it's kind of a mix. And so what I want to say is this is really busy because keep in mind, this is a winter month. This was November. The December numbers should be out any day now. But keep in mind, it's a small number, right? Because we're in a winter month. So, if a certain zip code normally has 10 sales in that zip code in a month, and then the next month they only have 9, well, that's basically more than a 10% decline, right? Even though it was one sale different. So you have to keep in mind, don't overreact to things going, oh my gosh, it's red, things are falling off. A lot of times it's a small sample size issue, but this is all of DFW, and then similarly, this is prices for all of DFW. But let's let's drill down by county a little bit. So Collin County, and I don't know if you can, this is the picture of the county, so keep in mind, I know we have McKinney folks and Frisco folks, and keep in mind in Frisco, the county line is basically right through Frisco. So you can see some Frisco and Prosper over here, and then I'll get to Denton County in just a second. But here's McKinney. We got a lot of bright green, but then you can look down here at Allen, parts of eastern Allen, I guess, and you can see big declines. So again, I wouldn't worry too much about it, other than to say that there are definitely pockets by zip code. Some have gotten hotter and some have gotten colder. It's not all red or all green. Okay. Home price, there were some slight declines across most of Collin County, a few 10% or more. Again, 1 month, small sample size, be careful, but generally prices were falling a little bit. If you want to look at Denton County, so this is now, if you want to look at Frisco, Frisco is over to the right. In fact, it's listed right there. So you can see that some of those West Frisco on the southern side have some big declines, but then on the northern side, some green. So quite a mix as far as it varies pretty wildly. But again, overall, I would say probably slight declines in average home price per square foot in November for Denton County. I'm not even going to go through this other than to say that I have Collin County stats and Denton County stats, is generally pretty slow in terms of number of units, and inventory is increasing. I'll talk about that in just a second. Collin County home trends, I'm not going to spend a whole lot of time on that because I'm going to run out of time. I see this chart a lot, and I sort of put my own commentary at the top here. A lot of people look at this chart, and maybe they only show the right half of the chart, and they show, oh my gosh, the sky is falling, the inventory is piling up, right? But if you include the left side of the chart and you just go, no, actually inventories, it's kind of back to normal. And in fact, I know we have some people who've been in the business a short time and some a long time, but anybody who's been in the business for the last 15 years, most of that period of time, we've been complaining about the lack of inventory. Like that we don't have enough to sell, and and sellers have way too much of an advantage. And I don't know if anybody in here is a new agent, but it's not normal to have to put an offer on a house before you look at the house. And that was happening, right? You had the people who put an offer on it, and then I'll go look at it if I win the bid. Or FaceTime, let's do a showing of you walking through the house. That was not normal. And so the fact that inventory, there's more options, it's a healthier thing. I know the listing agents get frustrated and go, it's harder than it was 4 years ago. But you buyer agents will go no, 4 years ago I ran myself ragged, and I was running all over town, and it was impossible to help a buyer. So inventory is much healthier now. Denton County, it's almost the exact same thing. Disappointing November, inventory is starting to pick up, but it's not picking up to alarming levels. It's more picking up to what I would call a healthy level of inventory. Okay. Case-Shiller. So this shows DFW. Case-Shiller has different metro markets, and I just found this interesting. It's showing that really, we showed the slowdown that happened in real estate in 2022 when mortgage rates went up. Well, according to Case-Shiller, the value of homes in DFW has basically stayed the same for the last 3 years, right? It's gone up and down with seasonality, but we are not at this price appreciation, that was happening before 2022. So whether that's good or bad, I don't know. I mean, we can all debate. Obviously everybody likes when their house appreciates, but from an affordability standpoint, it does not appear that we have runaway home prices. And in fact, if you look at the very far right of this chart, you might even argue, prices are down a little bit. And this all is related to the mortgage rates, right? And so I always think it's important now, especially now that I'm in mortgage, right? When people say, it's just funny to me, people say, oh, mortgage rates are so high. And so I always try to show this chart that shows since 1971, what are mortgage rates? And so you can understand why somebody might think it's high if they didn't get into the business, until 2010, right? Because 2010 to now, yes, it is higher now than it has been since 2010. But basically before that date, this is lower than it was any date before that. So it's all a question of perspective, right? Here's the last 5. This is the one they point to. Oh my gosh, look how much higher rates are than they used to be, which is also true. It's just a matter of perspective. So I like to look at the last 24 months. Well, actually, they're pretty attractive today relative to those 7.5s that we were getting. In fact, we're starting to see some refinances from some of these people who did purchase homes in the 7s, right? And all of a sudden they're like, okay, wow, this low 6s is pretty good. And my team is amazing at doing those. And so again, not that this is a purchase group, but the point is rates are not high. It's just a question of what your perspective is, okay? And how long your perspective is. Okay, so let's talk about where I think we're going, and then we'll open up to question and answer, and hey, did you think about this, or how does such and such figure in? So first thing I like to do is look at a couple of other sort of independent, semi-independent projections out there that produce really good forecasts. So this is from the Mortgage Bankers Association, and they actually project out a couple of years with very specific numbers. And in general, the key is they're expecting existing home sales growth by a little bit, a few percentage points, and actual prices to fall a couple of percentage points, okay? So not big spikes either way, but their projection is that mortgage rates are basically going to stay flat between 6 and 6.5. And that's not, because they're going to stay flat, that's not going to stimulate people. So we're just going to have slight growth, just like we saw in 25. I showed you that we were up a few percentage points maybe in 2025 versus 2024. MBA is projecting that exact thing, but projecting slight price decreases. Fannie Mae is actually expecting rates to fall a little bit further, down to the high 5s, 5.9 by the end of the year. So they're expecting volume growth and price growth. So still low growth on each, but they're expecting volume and prices to grow a little bit, but which makes sense. If their mortgage rate perspective is for rates to fall, that would stimulate more buyers, and that would cause upward pressure on transactions and on prices. Okay, so my thoughts. The first thing I think we need to all agree on is the federal government, and this is a nonpartisan comment because it really applies to all parties, but the federal government is going to do whatever it can to stay in power, right? I don't think there's any doubt that we've figured that out by now. And so keeping the economy growing is they have figured out, what was the guy, the Cajun guy who said to George H.W. Bush, he said, "It's the economy, stupid," back in the 90s. And anyway, so James Carville, thank you. And so that was so true then, and it's so true now, that the economy going gets people reelected, right? And if the economy falls apart, that's what gets you kicked out of office and your party out, okay? So I think that they're going to keep doing all this spending, keep pressuring the Fed to lower rates and all these kinds of things to stimulate activity. And so I think that's going to cause inflation to stay well above their 2% target, okay? I don't think we're going to get down there because there is this incentive to stay in office. I think rates are going to stay in this 6.5 range, right? It's going to bounce around depending on the information of the day. I was talking to Will this morning. He tracks the economic data maybe even more than I do, and we were talking this morning about the latest payroll number came out today, and it was weak, and so rates dropped down just a smidge, and it's weird. This bad payrolls equal yay for our team, right? Lower rates maybe. Nobody really wants payrolls to, we don't want the job market to lose out, but there is this dynamic. And so I think that the rates are going to stay somewhere in that, I don't think we're going to go to 5 this year. I don't think we're going to 8 this year. I think kind of where it's been. I do think we're going to have slight growth. I agree with that thought that we're going to have, a few percentage points, maybe 5% growth in, and I know nobody's going to jump for joy saying, yay, 5% better than last year because last year stunk. I think that's a reasonable expectation. Pricing, it really, and especially as we're in McKinney and Frisco and these markets, it really is dependent on how much competition you have from new home construction, right? Because I've worked all over DFW, and it's fascinating the difference between some of those markets. I mean, I grew up between Denton and Dallas. I moved back and forth quite a bit, and Denton remains a big growth and home builder and whatever market, whereas University Park, there's no construction. I mean, maybe a tear down and a rebuild, but there's no volume construction. And the difference that a building, that home builders can make to pricing is remarkable. So in markets that don't have home builders, I think we're going to see flat to slightly increased pricing. But where home builders are competing with existing homes, it's just going to be really hard for those existing homes to keep their value. So I anticipate a slight decrease in value because those home builders are really putting incentives out there to push their product, right? Because they're making money on the construction side, not necessarily, they just want to move the product, right? And if they have to give incentives, financial incentives, or cut price, they don't actually cut price. That's the funny part, is that they give these incentives to try to pretend like the price stays here, but they're really cutting price. I think we can all agree on that. So when they cut price effectively, that means that the existing homes in that neighborhood or that are one neighborhood over have some really hard competition to maintain strong pricing. So I think there'll be a little bit of softness there in home builder markets. I think we need to, let's see. I told you my debasement theory, right? So this debasement to me means being a homeowner is a really good thing in the long run, right? But you do want to buy at the best price you can buy at, and you want to buy at the lowest rate you can buy at, or eventually refinance into it, which we can help you with that. But the point is that there is going to be an opportunity, and I wouldn't be surprised at all. I kind of think there's going to be something this year that happens where there is a jolt that, and so whether it's this year or next year, I can't tell you for sure, but I listed a couple of things here, such as a stock market decline. Well, is anybody thinking that's impossible? We're at all-time highs on the stock market right now. So if there was somebody poked the AI bubble or whatever and says, this isn't real, or this can, just like the dot-com bubble or whatever. If that happens, well, then all of a sudden that top part of the K-shaped recovery, those people aren't going to be spending quite as much money, and there will be a temporary negative impact to the market, right? But the key there is temporary, and that's really my point here, is that's going to create an amazing buying opportunity, I think, because eventually what's going to happen is whether it's a stock market correction, the labor market cracks and we go into a recession, some sort of geopolitical event, oh no, that's impossible. Right. So I think it's going to be temporary though, because I think what we've learned over the last 15 years is that our government has no tolerance for recessions anymore. And they're going to come out with that bazooka and just go brrr and spray money everywhere trying to fix the problems, and it will paper over a lot of the problems. I think that's the one thing we've learned since the Great Recession of 2008. So I view any big pullback in prices to be or rates really, and it might be both, to be a really good time to buy, because I think in the long run, if you have a house, a neighborhood that you like and it's the right size, I don't mean everybody should just go out and buy houses willy-nilly, but if somebody's on the fence, or maybe they're a renter now but would kind of like to own a house, and they know they want to live here in McKinney or there in Frisco or down in Dallas or wherever, then all of a sudden there will be an opportunity at some point here to pull the trigger on a really good deal. And I know this is a little bit self-serving, but I think it's important that you have your buyers ready, right? And ready means like in the process, so that, even if they're waiting for that right price or that right entry point, a lender can help get them ready to go, because I don't think that's going to be a long-term, oh, it's going to be down for a year or two and then start going. Like, I think the short election cycles that we have now, like when the next shoe drops, whether it's international or stocks or jobs or whatever, the money printing is going to kick off even further in earnest, and that then causes further inflation, and you're going to want to be an owner of assets rather than a renter of assets. So I think, whether that's optimistic or pessimistic, I don't know, but that's kind of where I think we're heading in 2026, is a little bit better on units, pricing about the same, maybe a little weaker in builder markets. But I think there's going to be some really good buying opportunities, and you want to buy sort of like what we've talked about with stocks, buying the dips. I think that there are going to be dips caused by some of these issues that are short-term in nature, and you want to have your buyers ready for whatever those dips are, okay? So I guess what we'll do next is we'll do some question and answer. I know that, and by the way, this is all being recorded. Smile. No, just kidding. But there's going to be some microphones. So any questions from the audience, we're going to have people with microphones. So I know I could probably hear you if you yelled it, but we want to make sure it gets caught in the microphone so that I can answer the question and that the video can capture that. So what questions?
If you just repeat the question when it comes to
Oh, okay. We can do that. I can repeat the question. So, what? Yes, sir. The question is, talk about AI and why are people skeptical of it? And so, if you're of a certain age, and unfortunately I am, I was in the professional world during the late 90s and early 2000s. And there was this race, right, to build, the best example of it was, like, there were companies called, like, Global Crossing. That's one of the best examples I can give. And there was this idea that, okay, the internet is going to change our lives. Was that wrong? No, that was absolutely right. And in order for the internet to work well, you're going to need a bunch of fiber that runs, that people can transmit data and video and all that. Was that wrong? No, absolutely, that was right. So all these companies started raising all this money and laying fiber, whether it's under the ocean or across the country or whatever, to make this internet work. And they were going to be like the monopoly, they were going to be like the toll booth operator. We're going to lay this fiber, and we're just going to charge you some money every time you use our fiber. Sounds like a pretty good idea until somebody else lays fiber. And then all of a sudden, they all laid so much fiber, there was so much capacity that the value, the toll that you could collect from people sending data through your fiber was so microscopic because there was no incremental cost to it, right? So you just were competing with the other guy, saying who could undercut whom to get the data back and forth. And eventually, they couldn't pay back their debts, right? And so you probably haven't heard of Global Crossing if you're a younger person, because they don't exist, right? So before that, go back to the railroads. And I was not alive then, so but it was kind of the same thing of one railroad going across the country. That's great, but when you have 5 railroads all doing the same thing and trying to compete, well, it's really hard to differentiate. So the railroad business is not, aside from carrying freight back and forth, but it's not what it used to be, right? So that's the argument against AI. Is you saw my attempt at the Mr. T look, and so I clearly am not the AI expert, or I'd have a much better AI image. But the point of it is that we have all these companies spending so much money and raising debt to pay, and debt and equity or whatever to build out all these data centers and to build out all this compute capability. And the question is, like, is it worth it? And is there going to be a payoff? And is it going to change our lives? And like I said, the internet did change our lives, right? We do things totally different. Like the internet is amazing. I love, our lives are totally different. But, who made money on that? And who lost money on that? A lot of people lost money, right? And so the question is, yes, could AI be the next big thing? Yes. Could it really be a bad investment like it was in railroads or in Global Crossing? yes, if those companies can't figure out how to monetize it, and meanwhile there are, I can't even name all the big AI companies that are all spending all this money, and they're basically competing with one another, right? I mean, you may think of ChatGPT, but Google and Amazon and Grok and Perplexity and I mean, there's 10 companies out there that are spending so much money that that's the question, is whether it's all going to be worth it or whether they're all going to kill each other by not being able to monetize it, because that's, like I said, what happened with Global Crossing. So hopefully that answered the question. What other questions? The first and foremost best answer is, and I have learned this so much in the last few months, is the best resource is locked up in the heads of these professionals, right? And the key is to have that relationship where you can call or email any of us, and because every situation's a little bit different, right? And so what I have found is, I had one yesterday. I said, how do you do a deal in Mexico? Like, I have somebody asking me, how do you do a deal in Mexico? And yeah, I mean, maybe you can Google that or Grok it or any of those AIs. But the point is, what's real is you can just pick up the phone and call. And my agent client called me. I didn't know the answer to that question, right? But I had my teammates where I had the answer to the person within 1 minute, as far as, no, we don't do deals in Mexico, but maybe here are a couple of options that you might try. And that's, from our standpoint, I mean, this isn't about a pitch for Benchmark, but that is our pitch, is we want to be the call that you get, and then we may not be the answer. I mean, I've referred deals out to another institution or whatever, if they've got a such and such loan that maybe fits your situation better than what we can offer. But that's really the answer, is the telephone that you have to pick up and hit the speed dial. So there are lots of I mean, like Will Austin over here, we have a call every Friday that if you're interested in this, like, he is amazing with his analysis of where we've gone in markets, the actual data as far as rates, right? I mean, this is very much about rates and what's driving rates, what has driven them in the past, but what's more likely to drive them in the future. And this is every Friday. And so that's another resource that I would point to, is if you're interested in that, get with me. I can get you hooked up, or any of my teammates over here. But just things like that, where it's a lot of this stuff. I mean, sure, there's stuff on the internet that I could point to, but the reality is it's really working with an expert and the experience and what's in their head. Yeah, well, yeah, thank you. I was gonna forget. So, what are some positive things that might happen for the economy, right? Well, and all the things that I pointed out. I mean, they could kind of go one way or the other. I mean, like, we'll use the Venezuela thing, right? I mean, that could be disastrous, but it could lead to, a boom in oil investment. It could lead to a safer Western Hemisphere, so there's positives on that side, right? It could lead to World War III, and that's bad, but there are positives there. The AI thing, I mean, AI may end up changing all of our lives in a way that is really productive, right? So where it's a whole lot easier for you as an agent to do more work, because you've got these AI assistants who are helping. And I know that exists already, but I'm saying more and more each year. One that Tom and I were talking about a couple months ago, but like in 2026, toward the end of the year, there is the Genius Act that was passed last year by Congress, which is about stable coins. And again, I know when you start talking about those kinds of things, that wipes some people out. But like, that may force a lot of people to actually buy, or that might force people to buy treasury bonds, right? Because if they start using stable coins, and especially if people overseas start using stable coins, then the stable coin holders or stable coin company has to be backed by U.S. treasuries. The only reason I bring that up is, if more people are forced to buy treasuries because the world is transacting a little bit more in stable coins, that brings rates down, right? And we just talked about if rates come down, then that's going to drive a lot of activity in our world and really throughout the overall economy. So there are lots of positive potential, hiring, I said it's been kind of in the doldrums, but if you get this positive snowball effect, then obviously more people feeling better about their job situation can lead to more people with the interest and capability of buying a home. So, I started this by saying we're at a tug of war between the inflation and the slowdown of the economy. But there are plenty of narratives that we could thread that needle. Now, is it likely? It's hard for me to say, but there are some distinct possibilities that can lead to some really positive outcomes for the economy and for us in the DFW housing market. Okay, so the question was, there was talk a month or two ago about 50-year mortgages and also about portable mortgages, meaning, if you have a 3% mortgage but want to move it and buy a different house. There are two different questions. So the portable mortgage, I think, well, I'll make one overarching comment. I think President Trump, when he was throwing those ideas out there, it's not a bad idea to throw things against the wall and see what sticks and try to get people excited. I think it was a political move to get people excited, and it's really much ado about nothing because neither one's going to happen. The portable mortgage really can't happen because of contract law, meaning when you have a mortgage, if you have one of those 3% mortgages, right, and you've been in your house for 6 years or 5 years, whatever it is, that mortgage has been sold off or whatever, and so somebody else owns the collateral on that, and so you can't just take it somewhere and go, hey, ABC Mortgage or whatever, I'd like to bring my mortgage, somebody else owns the collateral to that old home, it's just the way the thing is set up, it's not possible. The 50-year mortgage is possible. The question is it worth it, right? And that one did cause a lot of disagreement, probably even with my own team. We didn't really kick it around or debate it that much other than to say that the benefit to the customer isn't that significant over the 30-year. Maybe the payment would come down a little bit. Generally, the rate would go up somewhat. So the payment may not actually be smaller. But I'm all for more products out. The question becomes, should we have an interest-only mortgage, right? Because some people say that you shouldn't have that. That doesn't. You need to discipline people and make people pay back their principal. And I'm of the opinion people should be able to have the options to do whatever they want to do as long as it's legal. And so the question is, should there be an interest-only option? In some circumstances, it's probably not overall the best idea for everybody. But so I'd say the same thing about the 50-year. It's probably not for very many people, but it's not really going to be an answer. It was more throwing spaghetti against the wall. Okay, well, here's what we'll do. I'm going to turn it back to Josiah, and I know that if you had a really nerdy question and were embarrassed to ask in front of this esteemed group, I will be here afterward, so you can come over and meet me in the corner, and we'll talk in hushed tones. But we appreciate it, and if our team at Benchmark Mortgage can be of help, my contact info is here, but also Will and Sue and Mike and Tom and the rest of my team, we'd love to help you however we can. And thank you for the opportunity to be here.